voting shares are first and foremost stocks, and they will get sold. I mean, it's not my opinion. Go and back test what happened go look at the start of 2020. Liquidity crisis, everything gets sold. Everything goes to a correlation of 1. The R squared goes to 1. Everything gets sold, except for what I just mentioned, the 4 horsemen. Go back to 2008. Everything gets sold. Gold stocks will get crushed because it's a leverage play on gold, which will in itself be sold because people need cash. All right? You don't pay for debt with gold. You pay for debt with dollars. The whole world does. The dollar is losing its world reserve currency status, but it's still the world's reserve currency, and there's a tremendous amount of dollar-denominated debt outstanding that has to be repaid in foreign currencies that are being torched. Okay, understand that. So, to answer that person's question, I don't believe, even though I'm considered a gold bug and I love commodities, in a liquidity crisis, everything gets sold. You will find zero protection in commodity-related equities or commodities in a liquidity crisis. Don't look for it. It's not there.
Following on that scenario, though, once you get past the liquidity crisis, then there's a recognition and awakening on the part of people that, this normalcy bias, this main narrative that we've been waiting for, the Fed's got your back, et cetera, ain't coming. The cavalry ain't coming. And then there's a shift into real things. Is that what you're seeing afterward that?
Well, the cavalry ain't coming as early as you need it to come because this is a new dynamic. This is a total new scenario. Since 1987, the problem has been, disinflation, deflation. How can I get to 2%? When we had the COVID breakout, inflation was below 2%. In 2008, inflation was below 2%, or right around that level. Now we have a totally different dynamic. Inflation is the problem. In fact, it's the primary problem. And the Fed understands that you can't have a normally functioning economy until inflation becomes tractable. And it just isn't. So no matter what happens outside of a liquidity crisis, no matter what happens in the stock market or the real estate market or the Bitcoin market, no matter what happens, they ignore that with the primary function to get inflation closer to their 2% target. And until that happens, look for more days like we had Friday and we're having today. We have a PPI print tomorrow. The Fed's meeting is on Wednesday. What are they going to do? Does anybody expect them now to say, well, you know what? We might pause again in September? Who was that? Loretta Mester said that the Fed might pause and take a look around in September. You can't. They can't and they will not pause until inflation is under control and or you see the economy completely wipe out. Maybe you get a couple of non-farm payroll reports that have a minus sign. That might give the Fed pause, but there's a lot of time and distance between then and now, where the market, which is still trading, the total market value of equities is still 155% of GDP. The average of that ratio is something like 70%. So you have a long way to go before we're anywhere close to fair value. And of course, markets really don't crash to fair value and stop. They usually become undervalued. So I'm sorry to for my investors, this is wonderful. I think this is wonderful for America. I love America. You love America. We love people, love God. We want this to happen because you need it to happen. I mean, do you find happiness in the fact that first-time home buyers cannot afford a home? Is that normal or natural? No.
No, in fact, that's exactly where we were going next, was about real estate. We've mentioned it in passing a few times. We haven't talked about it yet. Paul Dreyer says, what does Mike think about housing for first-time home buyers? When should they enter? This is about 6 or 7 different questioners all asking the same thing about the housing market, wondering what your outlook is on that.
So I think home prices are going to go down between 20 and 30%. Full disclosure, I just bought a house. I bought a house because that wasn't part of my calculation. I did it for other reasons, mainly my daughter who wanted a house and wanted it then. So, I'm in a different financial position than most people. But if I could wait, I would wait, because I think we're going to have a collapse around 20, 30%. bear in mind that the structure of finance and housing is much better than it was in 2008. Okay, so you don't have the ninja loans, you don't have the no doc, hey, I have a heartbeat, give me 5 houses. Oh, sure. Underlying standards are much stricter. However, here's the caveat, the home price to income ratio is higher than it was in 2005 and 2006. So the foundation of the home prices is much weaker. And the number of homes owned by institutions and investors is 20 to 25%, depending where you live. So, when Blackstone realizes that their income stream from their renters is no longer there because people are losing their job and their principal on their speculative homes is going down, that's a real balance sheet awakening. And they will start putting these homes on the market and you'll be overwhelmed with supply. I don't want to hear, there's, the demographics, there's a lot of people. Listen, if I just told you 1 out of 5 or 1 out of 4 homes is owned by somebody who doesn't live there, that means there's a lot of supply that can come on the market if home prices stop going up. It becomes a liability. You have to pay property taxes. Your renter isn't paying. There's maintenance. It's a huge liability, and you will sell these houses on the market. All markets function on the margin. On the margin, these homes will come flooding on the market, and home prices have to go. That's me.
I guess that's a corollary to your postulate earlier that in a liquidity crisis or in the kind of crisis that you're talking about, that things are going to be liquidated, and that's just one more example of that.
Well said.
We've got more questions we're going to have time to get to today. There's a question about people who are Austrian economists or fans thereof have been talking about a crack up boom where there's this blow off top where it seems like the market just does this obscene melt up in defiance of all natural laws. Now, you've been pointing it to us for a year and a half or more that the valuations, no matter how you measure it on the stock market, is in bubble territory. But do you see the likelihood of yet another blow off top or market melt up before the major declines that you're talking about?
I won't mention the person's name that's popular in saying this, stocks are going to go up 80% or up 60% before they crash 80%, or one of those. I forgot what he said. Why are we even talking? I mean, this person is wrong. These people if that's the postulate, it's just wrong. It's already proven wrong. The peak of valuation in the stock market, which was at the end of 2021, was 210% market cap to GDP. Now at 150%, as I mentioned. It's over. The average stock is down over 20%. Almost 50%. The averages are now in bear market territory. The combined portfolio is down 32%. It's over. There is no crack up boom. The money supply is full. M2 is plunging. The Fed's balance sheet is rolling over. Banks are reining in credit. What in the world would be the fuel for this market to surge by 60%? I mean, pretty soon he might be right. Goes back 60%, it'll be even,